Hello, I'm Regina McCann Hess, president of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about building your financial literacy, and we're really going to be honing in on how to figure out your credit score. A lot of times, we talk about building your wealth and talking about the investment side and your asset side of your balance sheet, but we also have to think about the liability side of your balance sheet. So, it's important to understand that and how things factor into that. So, we're going to talk about that today. And one of the first steps in building your financial literacy is learning the ins and outs of your credit score. So we're going to talk about a roadmap about how to do that. Your credit score reflects information in your credit report. So let's start with the credit bureaus and what's in a credit report. There are three major credit bureaus that provide these credit reports, and names that you've heard before: Equifax, Experian, and TransUnion. Now, remember, under federal law, each credit bureau is required to provide consumers with one free credit report each year. And you can go to the website annualcreditreport.com to request that report for you. So, how do the credit bureaus report on you and your credit? Well, first, they gather data about you from the lenders on different types of accounts like credit cards, car loans, student debt, mortgages, the date you open the account, your credit limit or the account balance, and your payment history, including whether or not you have made your payments on time. So, how do they create the credit report? The credit report actually contains four sections. There's personal information, your credit and payment history. There's public records, which would include bankruptcies, judgments, tax liens, and collections. And finally, entities that have requested your credit report. Now, they provide these reports to certain third parties. The credit bureaus can provide reports only to lenders that you're seeking credit from, lenders that have granted you credit, your telephone, cell phone, utility companies that may provide you service, employer or prospective employer, but only if you agree to that, insurance companies that have issued or may issue a policy for you, and also government agencies reviewing your financial status for government benefits, or of course, a business with a legitimate need, such as a landlord or a bank. What is a credit score? So let's look into the credit scores. Credit scoring companies take information in your credit report and use models to create a three-digit score that reflects how likely you are to repay that debt. Your score is largely based on information from your credit report, like the payment history, the amount you owe, how long you've had credit, what types of credit do you have, credit cards, car loans, student loans. They look at your mortgages, and the types of requests for your credit reports. There are two types of requests for credit reports, and those could be hard inquiries or soft inquiries. A hard inquiry is generally when a financial company checks your credit when making a lending decision, and you typically do have to authorize them to do that. A soft inquiry is when a person or a company checks your credit to see if you qualify for promotional offers or as part of a background check. Now, your permission is not needed, and soft polls do not affect your credit scores. Usually, only the hard inquiries will affect your credit scores. Then we're going to talk about FICO scores. FICO scores are the most widely used credit scores. There are a number of credit scoring models. However, FICO scores are used by 90% of the top lenders. Back in 1989, the Fair Isaac Corporation introduced its FICO score, which helped standardize and removed bias from lending. Now, there's different scoring points. I'll go through them really quickly. But basically, you range from very poor rating all the way up through exceptional. A very poor rating is going to be anywhere from 300 to 579 on a FICO score. A fair credit score is going to be anywhere from 580 to 669. A good credit rating, or FICO score, I should say, is 670 to 739. A very good FICO score is going to be 740 to 799. and an exceptional score would be 800 to 850. So there's a lot of segments in there that could are tailored into that FICO score. Now, the FICO models are tailored to industry specific products. These scores are from FICO's basic model, so that they help the lenders make more informed decisions. And the FICO tailors their models for industry specific products. So the credit bureaus also use the FICO scores as part of their models. So there's a lot of different scores out there. Your score's also constantly changing because there's new data being added all the time. So let's talk about the components used to calculate the FICO score. There are five major points to this that go into your credit score, and there's a few suggestions to consider to keeping a healthy score. So your payment history, that's 35% of your FICO score. So that's really important to be consistent with your payment history and your bills. Amount owed, that's 30% of your score. You might get a great offer in consolidating credit card balances. However, that could actually bring your credit utilization rate above 30%. So, an example of that would be you have two cards, each with a $1,000 balance and a $5,000 credit limit. Your credit utilization rate is basically 20% for each of those cards as it stands. But if you consolidate to one card, you now have $2,000 balance with the same $5,000 credit limit, but your utilization rate jumps to 40%, and that actually will hurt your FICO score. Another item would be lengthening of or length of credit history, and that's 15% of the FICO score. So you don't want to close a credit card account, especially if it's a card that you've had for a long time. You just stop using it. New credit counts for 10% of your FICO score. So hard inquiries can affect this part of your credit score. So if you want to buy a new car as well as new furniture, consumer organizations suggest that you plan ahead and space your request out for credit over at least 6 to 12 months. Conversely, if you're rate shopping, you want to keep it within 45 days so it counts as only one hard inquiry. And the last part of the FICO score is your credit mix, and that's 10% of the score. Have different types of credit to show that you can manage credit cards, retail cards, a mortgage, and car loans. So that's 10% of your score. Why does it matter? Well, healthy credit creates buying power. Your credit score is one of the most vital parts of your financial life, and it follows you everywhere. Your score actually determines if you'll be approved for a loan or not, the amount you qualify for, and the interest rate you'll pay, as well as the credit terms. People with higher scores generally get the better deals. It could also impact your employment potential and also fees paid to utility providers. When you go to rent an apartment, they're pulling your credit score as well. So many people think a credit score only really matters when it comes to being approved for a loan or a credit card, but it goes really well beyond that. Utility providers can check your score and charge higher fees or rates if you have a lower score. And many employers will use credit scores to screen prospects, and landlords want to know how likely you're going to be to pay rent. So now that we know that, let's talk about how you would hurt your credit score. Obviously, we don't want you to do this, but we want you to know what does hurt your credit score or impact your score negatively. Some of it's basic stuff. You miss a payment. Well, delinquencies can remain on your credit report for up to 7 years. You max out your credit card. Keeping balances low or at least below 30% of your credit limit will be better for you. Applying for too many cards or loans in a short amount of time, don't apply for too many cards or loans within a 6 to 12 month period. Canceling cards with zero balances, that has a negative impact. Transferring balances to a single card, again, remember below 30% of your credit limit is where you want to be. Also, co-signing a loan or adding a person to your credit card, you're adding someone's past to your credit history. So be very careful about that as well. And then this is also something that will hurt your credit score, letting any credit report errors go undisputed. So I mentioned earlier that you can go to annualcreditreport.com and request a free credit report each year from each of those three big credit bureaus. But the thing is, you need to check the report. You need to look through it. Are there any discrepancies? You want to make sense of that. You want to go back to them and say, hey, I want this fixed. This is not true. So you definitely want to check the credit reports regularly and, of course, fix all those errors that pop up. And they do pop up. You also want to avoid debt settlements and foreclosures or any kind of liens. Most public record items remain on your credit report for 7 years, although some bankruptcies remain for 10 years. So let's be careful there too. So, tips to improve your credit score. Let's talk about some things that you can do there. Let's make our payments on time. A late payment can be a 100-point hit to your credit score. Keep tabs of your credit utilization rate. Remember that 30% rule. You can call your credit card company and ask them to raise your limit. Or make some small changes or make small charges there instead of larger charges. Time your applications carefully. Hard inquiries can last 2 years. Also, apply for new credit only as needed. You want to pay off your debt, don't move it around. And again, fix those credit report errors. How to find your score. Many people think their credit reports contain the credit score, but that's not really the case. So, how do you get your credit score? Here are a few ways. Many credit card and loan companies provide your credit scores for their customers. It might be on your statement, or you may have to go online to access it. Banks can also provide your score as part of their service as well. And you can pay a credit score service that monitors your credit. Some services offer free trials and subscriptions, but really, honestly, if your bank will do it for you for free, then that might be a better option for you. You can also buy your score directly from FICO or other credit bureaus. If you purchase your score, you are not required to buy a monitoring service. Let's look at some action steps. Check your credit report. Now, that doesn't just mean for yourself, it means for everyone in your family. Like if you have younger kids or older kids, even that are still, under your roof, you actually want to check their credit report as well, because sometimes when we have these, data breaches, if they were at a medical facility or a doctor's office or a dentist's office, their records were breached as well. So their social security number may have been used for identity theft. So you want to pull their credit reports also. Be careful of suggestions. Know what hurts and helps your credit scores. Don't ignore signs that something has gone wrong, like small charges you don't remember, unrecognizable bills. Those are signs. Pay attention to them. Put together a budget so you know how much you spend and where your money is going. And of course, communicate, especially if you co sign for a loan or credit or commingle your money. You want to communicate with the other person or people how that's being paid. Is it being paid? Are they payments on time? Because if they're not, that is going to impact your credit score as well. I hope this helped looking at the other side of the balance sheet. As always, I'm happy to be here with you. Again, I'm Regina McCann Hess, president of Forge Wealth Management, and thank you for joining us for Women in Wealth. My website is forgewealth.com, and you can find me on Facebook, Twitter, and YouTube at Forge Wealth. And on LinkedIn, I am still Regina McCann Hess. I keep trying to put LinkedIn somewhere else. Have a great day. Thank you for joining me.